21. That was a duplex. And then I just kept buying. I started doing the Burr model. I'm sure your listeners are familiar with that. And I graduated slowly, single family home, duplex, then fourplex, smallplex, and then got to where we are today, where we're buying some larger apartment complexes. And yeah, that's kind of how we got here.
All right. Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appelman. Today we're joined with Matt Cox. He's founder of Saucetown Properties, host of the Saucetown Investor podcast, and real estate operator who has scaled a strong Oregon rental portfolio starting from cold calling. Matt, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, Josh, great to be here, and thank you for the invite. Nice to chat with you after interacting a little bit on LinkedIn. As far as me, I grew up in Oregon. I was born in Seattle, Washington, but I grew up in Salem, Oregon, lived there all the way through high school, ended up going to college, I should say, back up in Tacoma, Washington. Then after that, I lived in Seattle. I lived abroad a little bit, then came back to Oregon, lived in Portland, Oregon for about 7 years. And now I am in Manhattan, New York City. And I've been here for about, four and a half years now.
Got it. Very cool. Well, today we're gonna dive deep into remote investing and all the things, especially coming from you. You're a seasoned operator. I think this one's going to be good because one of the most difficult things I think from an operator is investing out of reach, because you have control when you're within arm's length of all the properties. So you're putting a lot of trust out there. If you could, let's start with your first real estate project, how you got into real estate, and then we'll get into how you started getting into remote investing.
Yeah, so my first dive into real estate, I was working as a cold caller and acquisitions guy, basically, at a real estate investment company in Portland, Oregon. And the guy I worked for, he exclusively pretty much bought house flips. We bought foreclosures, so I was on the phones all day, every day, calling on foreclosures. I learned a ton of sales and phone skills there. I frankly didn't learn a ton about real estate as far as how to underwrite a deal or how to get a loan or how to manage tenants or anything like that. But while I was there, I did end up buying two properties. One was my personal residence on Southeast Hawthorne, if any Portland people are listening, great neighborhood over there. And then I also bought my first investment property, which is a single family home in Salem, Oregon. And at the time, that was very much just kind of, I'll just buy this thing and put it away for my retirement, and it'll be a nice thing to have in 20 years. There was no intention really of doing it at scale or doing it as a business. I just was, I was working at a company where I had access to some pretty good deals. And so I bought one, and that was in 2018. And I didn't buy anything again until COVID. And that's really when my business started, if you want me to dive into that.
Yeah, for sure. Give us the nuggets. Because a lot of the listeners are learning how to get into real estate, one. And then the second is, how do I make this into a business and scale it? And then it's something that's survivable. So you got into real estate, you purchased your two properties, and then tell us about where it went from there.
So 2020, we all know what happened. I was at a different job working in corporate sales, totally unrelated to real estate. I sold aviation data to airports in the US and Canada. And I won't do a deep dive on aviation data. I just kind of took the job and didn't really know what the heck it was. But anyway, it was a corporate sales job, and COVID hit, and I knew airports were just at a standstill. So I knew none of my customers were talking to me. They're all in survival mode. I basically figured out I wasn't going to make any commissions for the foreseeable future. And so I said, okay, I better find a way to make some money. And like I said, I didn't learn a ton about how to buy deals and stuff at my previous job. So I just dove in listening. I had tons of free time, and I knew I needed to make more money. So I dove in on, like many people you've probably spoken. Maybe you're the same, Josh. I started listening to Bigger Pockets. I must have listened to 200 episodes at the beginning of COVID. I read a few books, but then the key thing I did, I mean, you touched on, for people starting out, I started buying deals, and that is the key. there's so much content out there. There's so much learning that you can do, but don't do it at the expense of taking action. So it's great, listen to this podcast, listen to other podcasts, read. It's great to educate yourself, but the greatest education you will get is from doing deals. So I bought my next deal in May of 21. That was a duplex. And then I just kept buying. I started doing the Burr model. I'm sure your listeners are familiar with that. And I graduated slowly, single family home, duplex, then fourplex, smallplex, and then got to where we are today, where we're buying some larger apartment complexes. And yeah, that's kind of how we got here. And I should add, I stayed in my corporate sales job until August of 23. So I've been full time on this for, what is that, about 2.5 years now.
How many units are you up to?
We are up to 65 units and hopefully counting. We got a couple offers out right now on some pretty good deals that we're hoping come together.
All right. Tell us your structure, how the operations go, and who's in charge of the grounds part, the boots on the grounds, the operations piece.
Mhm. So that's the most common question I get is how do you run your business and a business that operates exclusively in Oregon from New York? And I know people want to know about remote investing. My advice, I would not. So the reason I invest remotely is because I moved to New York and I had already started building my portfolio there and had started building my team from brokers, lenders, contractors. I had those systems in place. I would not do this if I say I was still living in Oregon. I'm not big on just picking out a random city on the map and starting to invest there just because you in real estate, you want to have market expertise, you want to have a competitive advantage. And people always ask me, I moved to New York City, when are you going to start investing in New York? And I've thought about it. It would be fun, but it's like I don't know the market here in Portland or Salem or whatever. I know if you go two streets this way, it's good. If you go two streets that way, it's bad. And I don't know the laws here. I'm big on picking a market, maybe a couple markets, and getting the benefits of that knowledge compounding over the years. As far as our operations, I've got my boots on the ground. Like I said, I've got my brokers, my contractors. Obviously, if we're doing, if we're under contract on a deal and we're raising capital for it, I'll fly out there. It's about a 6-hour flight, and my family's still out there too, so I'm out there a number of times throughout the year. But yeah, my team, I have 3 virtual assistants. They're all out of the Philippines. They run a lot of the kind of day-to-day property management stuff with repairs and maintenance, setting up showings. That's another one. I have a woman that I've hired who's my boots on the ground that'll go and handle showings, or will handle tenant move in, move out walkthroughs, getting keys made, kind of odd jobs and things like that. But yeah, we're a pretty small, lean operation right now. But so, like I said, I have two assistants that handle the property management, and then I also have a third assistant, but he's more focused on like our podcast and social media presence.
So how did you get to this point where you've got, you're approaching soon to be 100 units, but how did you started with two properties, and then in 2023 you went full time. How did you get to where you're at now with the amount of properties and investing from New York?
Yeah, so early on, we've started raising capital recently. Early on, it was all my own money. There was a few deals I would bring on, like one strategic, like my brother did a few deals with me and stuff. It was pretty much my own money, and it was the biggest tool that I used early on was the Burr model. That's the way to do. People always here. In fact, this was how I felt when I had that job at the real estate investment company when I was working in Portland. A lot of people hear real estate and they think, oh, I got to have a ton of money laying around, a huge war chest and all. And I didn't have that at the time. And so the best way to do it was to buy these off market properties, fix them up, renovate them, refinance, and get my money out of it. And then, during that time, I had the benefit of buying some properties at a pretty good time during COVID. The market did really well. And once you start kind of, I think it's sort of like a chessboard, right? You start stacking these assets, and you can move them around, you can play with them, you can, value goes up, you can refinance, pull money out of it. And that's how I started expanding, is I would be able to pull money out of a property and buy another one. And I've kind of rinsed repeated that process. And I had money saved up in savings. And I'm not getting into all of these with zero money down. I don't want to convey that. But now I am at the point where I'm raising money from outside investors as well, and that's helped us scale a little bit more quickly, and hopefully get us to that 100 doors you referenced fairly soon.
Yeah, yeah. I think that's the biggest piece is recycling the cash that you've created and equity that you created, cashing out, and then redeploying that to the next property. And I think that there's a lot of hype out there, zero down money deal, getting into a property with zero money, and that is the most dangerous strategy, I will say, is trying to find a deal with zero down. Because if you have zero cash in the bank, real estate is not the game to play. It's not to go find an owner that will let you just take over the mortgage payments when you have zero in the bank to take care of anything that might come up in real estate. And that strategy is being set out there. At least it's being pumped and hyped, but I think it's a bad move, because there are stories where people will go into a property, zero down, take over the mortgage payments. They can't find a tenant, or a tenant doesn't pay, and then the mortgage goes in default, and then the whole sub-2 transaction is just goes totally unraveled. And then it gives that strategy a bad name when it's just an irresponsible operator or trying to be investor. So it's important to have like cash in the bank, money put aside, like you had mentioned, and be able to operate the property. What kind of underwriting are you doing, and how are you finding these properties to then bring in new capital to invest alongside of you?
So we are. I have brokers on the ground in Portland. We've been buying, like, the last couple deals we bought are just on market. It's a really good buyer's market right now. I mean, you guys have probably seen, like, the national sentiment around Portland is not good. I think they came out with that annual. It's survey data. It's not like, quantifiable necessarily. It's surveys, but it does measure sentiment. And Portland was like 80th out of 81 markets. And a lot of people look at that and go, okay, like, why would you ever want to invest there? And that's kind of our exact thesis: is you want to run into spaces where other people are not buying. And so there are deals all over the place right now. I mean, you look at, what are the markets that everyone told you to buy the last few years, because it was an easy story to tell around population growth and these city, and that's where a lot of people are blowing up right now in the Sun Belt, Austin, for example. So it's a bit of a contrarian thesis, but because of it, we're able to buy deals that, before we do an ounce of value add, they're cash flowing day one. We're not going into bridge debt. And so we're able to pick these up. I mean, there's deals on market. We're looking at a couple off market right now. But yeah, our main lead source is just our brokers that are on the ground there.
Yeah, it's there's still I'm going to say that I'm in Cincinnati, and there's still a big disparity between buyers and sellers' expectations. Just over the past week or so, there's what is the guidance on this 97 unit? What is the guidance on this 120 unit? And the guidance versus the in-place NOI is, I mean, it's just plus you still need to go in there and renovate and drive occupancy and re-tenant. It's just there's I don't feel like we're still there yet, or I'm not seeing something that everyone else is seeing. Maybe
Yeah,
I'm not
we're
sure.
seeing it in Portland too, because there's not a ton of distress. So you have these sellers who the value of their property has plummeted, but they don't want to come down and meet the market, and they're not forced sellers right now because they're not hitting balloons, or they're not in distress. They just have a property that's dropped in value. And so, we're having a lot of situations where we put in an offer, they don't like it, and then we kind of just keep circling back with them. And then, I mean, the last couple we did are perfect examples. And then months later they test the market, and they come back to us, and we make a deal.
Yeah, and it's so there's a couple. I just don't even want to reply to the brokers after they've stated their the guidance, and it's just not to be rude, but it's so far from even circling the wagons around to see how the numbers pin out. And I think it's a Midwest thing. There's definitely pockets. I like boring tertiary areas, and that's where you can usually find properties that might pencil, might not. But for some reason around this area, it's just not. I can't find anything out there. But you got to keep on looking. So you're from New York. You're investing in Oregon. What I think the biggest piece is investing from afar, because I'm a big proponent of invest in your backyard. I can go walk a site. I've got a really good team behind me, but I can always go walk a site and find things that are wrong, find problems. I can find things that were not caught by them, and for whatever reason. So I can create a work order, or call a work order in, be creative, get it done. And that's why I like living local and investing local. But tell us some learning lessons that you've found that might be give you a stronger case or basis to invest out of state.
Yeah, I think one of the best things about it for me was that it forced me to build systems around my business, because I don't have the option of driving over to a property and handling something. I had to hire the right people. We have to have everything. We call them our playbooks. They're like, or SOPs would be another name for it. You have to have everything documented. If X happens, got an ambulance out there?
Yeah, I'm downtown Cincinnati. I just muted it because there truly was an ambulance driving by.
Where was I? Yeah, so I mean, that's one benefit of it, is it really did force me to build this like a business rather than a hustle. Now, to your point, there's certainly merit to what you're saying as well. I do want to reiterate, particular. So I've bought deals with my own money before that I have never even walked in person. I send my team there, I send my contractor there, I send my broker there, and if the numbers work, I'll buy it. Now, if I'm raising money on a deal, I will never in a million years do that. We set eyes on everything, and walk all the units, all of that good stuff. Taking on other people's capital is a very, very serious endeavor, and I hope everybody knows that. Now, as far as the day-to-day operations, your team is going to make or break you, and I think to a certain extent that goes even if the property's in your backyard. But you got to hire good property management, which is hard to do. The best property manager is still never going to care about your property as much as you do, and that doesn't make them a bad person. It makes them human. It's not their property. And so you have to have oversight of that stuff. And, we do, and I should also point out, we do self-manage a number of our properties as well. That's why I've built that internal team. But yeah, there's pros and cons to it, like anything. For me and for my investors, I've determined that this is actually the best route because I know the market so well. And if I were to invest in my backyard here, sure, I can walk over to properties, I can go see stuff, but I don't frankly don't have any competitive advantage here.
Yeah, no, I totally agree, and I think it does depend on the size of the properties too. I've got a scattered site portfolio ranging from a single family house, duplex, quads, up to 144 unit property. So it's everywhere in between, 48 units, 33s. But it's a scattered site operation. So having more boots on the ground, we self-manage versus plugging into a different economy / market, state, city, and starting out at like a 200 unit community. Now you've got your systems in place already at the property level, and you buy the people along with it. So And then you're kind of outside managing the systems, making sure KPIs are in place, making sure that the rent's being pushed, asset management more than anything. Is that kind of what you all are taking? Is pushing performance, or what KPIs are you looking for?
Yeah, we're pushing performance, and that's a important thing you point out for people listening. Your property manager is not your asset manager, and that's, I think, a mistake a lot of people think, is they give the property a property management and expect them to execute for them, and they can certainly help you. But yeah, what we're buying right now, we're not looking for huge like renovation value add type deals. We're looking at the 10 to 45 unit space, usually mom and pop landlords who haven't kept up, maybe haven't put a microscope on their expenses in 5 years. The last property we bought, we created a bunch of we got, what was it, a 6% ROI before the second we closed, just by getting a new insurance quote. Low hanging fruit, people that aren't maybe instituting rubs, or they're paying too much for garbage. They're not paying a ton of attention to that stuff, because in many cases maybe they inherited the property, or they bought it a while ago and it's cash flowing, and they just frankly don't, they're not really there to push the envelope. And then of course the revenue side of the business, which is looking for rent rolls that haven't been kept up. And that's the good thing about this environment versus 3 4 years ago, is you had to take on more risk, because prices were getting pushed up, and because of that you had to buy these big value add projects. You had to go into bridge debt, and now we're putting perm debt on these. We have a business plan in place, and we're just slowly pecking away at the expenses, and building the rent roll and creating a lot of value just by doing that.
Very cool. So just to kind of go back, you've started locally. All the properties that you purchased, you were living local at that point. You learned the market, you knew the market. You were you were boots on the ground, and then you moved abroad. So you're not living abroad, or you're not living out of state and then investing into a market you didn't know about first. You knew the area, and I think that's an important piece, because you knew what neighborhoods to avoid, because there's always neighborhoods to avoid. There's areas to avoid in any city. That just goes with it. But you were a resident expert on the area, and still are. And now you know what properties to invest in and where they're at, and where to go. And you've got a team built up, local team that you trust with the properties, because that's all important. That all makes sense. That makes for a successful out-of-state operation to invest into. What would be some learning lessons you would give to a beginning real estate investor that is looking out of state to invest in?
I would, I'll come back to what I said. I would only invest out of state if you have some sort of competitive advantage. So in hindsight, I'm very glad I didn't do this, and I bet a lot of investors can probably relate to this. When I was starting out, like many people, my entire objective was to get out of my W-2. And how do you get out of your W-2? You need cash flow, right? And so what that leads you to do, I remember this vividly. I would be on Redfin all day looking at properties, and I would search all these markets that were like cash flow markets, like Kansas City, Missouri, or Milwaukee, Wisconsin, or St. Louis. And I came very close to just buying deals. I'd find some broker online, I'd find some crappy property in the hood, and when you look at that, the cash flow numbers look excellent on paper. But you don't know the neighborhoods. You don't know how difficult it can be with, certain types of tenants. You're going to have late rents. You're going to have unpaid rents. You're going to have more repairs. And so it's tempting to become like a spreadsheet warrior and look at these markets that maybe you don't know very well, but the cash flow looks great on paper. And so, yeah, I'll just come back to invest where you
Yeah.
need to have some sort of competitive advantage. The other thing I'll add is, once you get going, I'm not a big advocate. Maybe you're different it sounds like you're mostly in Cincinnati, but I'm not big on bouncing around markets either. I think it's good to maybe have a couple just in case your home market overheats and you don't want to buy there because the market's too hot. But I'm not an advocate of bouncing all over the country buying deals.
Yep, I totally agree. Yeah, and we've got Northern Kentucky, Cincinnati, Dayton, and Lawrenceburg, Indiana. So it's a tri-state area, but it's a large area too. So very cool. If somebody wants to get a hold of you, Matt, check out some deals that you might potentially invest alongside of you, how can they reach out?
Yeah, you can add. I'm very active on LinkedIn. It's Matthew Forrest Cox. Middle name is Forrest with two R's. Funny story. I had to change it. I had to put my middle name in there because there's a mortgage fraud guy named Matt Cox. So I had to throw my middle name in. You can add me on LinkedIn. My podcast is called the Saucetown Investor. That's like a sauce, like a hot sauce. So SAUCETOWN. My blog is also the Saucetown Investor. But yeah, I'm super active on LinkedIn. You can also find us if you want. I mean, yeah, the best way, if you want to look at some of our deals, just DM me on LinkedIn. I respond on there. Or if you just want to talk real estate, if you're getting started, I take everybody's calls. I like meeting new people, like helping people. So feel free to reach out.
Awesome. All right, Matt, definitely appreciate your time. Look forward to following you. Thank you. All
All right. Thanks, Josh.
right, bye.